DermBiz episode 7. In this episode, we're going to talk about how to alleviate some of the financial pressure and stress that you're feeling as you're running and building your medical practice. We're going to do so by discussing net profit margins. We're going to talk about why net profit margins are important, how to calculate net profit margins, and the 5 killers of a great net profit margin for your practice. DermBiz episode 7. Let's get started. The first day we had our schedule all put together, and I remember sitting at the front desk and thinking to myself, how did we get here? How do we get here? We're working hard, we're putting in the time, we're doing the things that they say is necessary to start and grow a practice. It just wasn't coming together. We didn't see how this was a sustainable thing. What if this was a mistake? So in this video, I'm going to explain how measuring the wrong metric can be a huge mistake for your practice, and what metric you should be looking at regularly to determine the health of your practice. I'm going to start by telling a little story. I remember when we first started our practice, it was 2018. We had put all of our savings, about $150,000 into the practice. We had borrowed another $250,000 to start the practice. And, we did all the things, right? We advertised the newspaper, social media. We reached out to different hospitals who didn't provide dermatology, hoping that they would bring referrals and send referrals to us. We had the first day, we had our schedule all put together. And I remember sitting at the front desk and worrying. I remember it was 8. Our first patient was scheduled at 9 o'clock in the morning that day, and the nerves are starting to creep in. And I'm thinking to myself, what if no one shows up? What if the recruiter who told us during this process that us starting a practice as a solo practice, it would never work because we weren't big enough to be able to compete with, the private equity backed other dermatology practices out there? What if this was a mistake? And 8:35, no one's there. 8:40, no one shows up. 8:45, no one there. 8:49, the 9 o'clock patient shows up. And then after that, the 9:15 patient. And then everybody, for the most part, everybody who scheduled that day showed up. And after that, we started to see huge growth week after week after week in our numbers. And literally from that point forward, we typically didn't have any issues with scheduling patients for years. And, the arrogance in me at the time thought, this isn't that hard. This isn't difficult as I thought it would be. And so here's what we did. We thought to ourselves, if some patients are good, a lot more patients are better. And how do you see more patients? Well, you have to grow to see more patients. We had to hire more staff. We had to hire more providers. We had to expand our hours of operations in the days that we were seeing patients. We went from 6 to 18 in about a year and a half. And, what happened was our revenue doubled. When we first started, when we were kind of a small practice, we were doing a little bit over $1 million a year in revenue as that 5 or 6 person practice. And, when we increased our numbers, increased our staffing, increased our cost in a lot of ways, our revenue doubled. We went from, a little bit over $1 million to about $2.3 million in revenue. However, our expenses quadrupled. And that put us in a situation where, at rock bottom, there was a point in time where we weren't earning enough to pay ourselves as owners and managers of the practice. So we were paying everybody else. The tax man was getting paid. The places that we were renting from was getting paid. The insurance was getting paid. The staff was getting paid. All the money. It was almost like we were just stewards of money. Our job was to bring in money and then give it away to everybody else. It wasn't a fun experience. It was around that time where I remember sitting down and doing the bookkeeping. I do the bookkeeping every week, and thinking to myself, how did we get here? How do we get here? We're working hard. We're putting in the time. We're doing the things that they say is necessary to start and grow a practice. However, it just didn't seem like, as they say, the math wasn't mathing at the time. It just wasn't coming together. We didn't see how this was a sustainable thing. And it was around that time that I was introduced to a concept that I had heard before, but I really dug in deep this time on that concept. And that concept is called net profit margins. Now, let me explain exactly what net profit margins is. Net profit margins is the percent of revenue left over after accounting for all expenses, including cost of goods sold, operating expenses, and interest payments. And so it really gives you a breakdown of how you're doing, not just your revenue, because if we were just tracking revenue, we were doing 2 times better than we were in the beginning. But our net profit margin said that that number had been cut not in half, but it was less than half. And so we had to figure out how to do something different. I know that some people are out there thinking accounting terms, blah, 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 blah. This is super boring. I'm not going to get down in the weeds too much with the concept of net profit margin and a lot of accounting terms. So we'll just keep it very simple. After you subtract the cost of running your business, after you subtract the taxes that are available, you take that number and you divide it by your revenue. I'm simplifying it. It's a little bit more to that, but that's basically it. You take that number and you divide it by your revenue. And so initially when we did that, our numbers were, our net profit margin was, anywhere from 35 to 45%. And that was regular, 35 to 45%. We were on the higher end, more 45% in the earlier years as we were, when we were a smaller practice. As we began to grow, those net profit margins began to decrease. And I believe that your net profit margin is the score that will determine how well you sleep at night. Some people believe, and initially I thought the higher the revenue, the better the practice. So if we could just increase revenues, it'll take care of everything. But what I was failing to consider was it's not about how much money you make, it's about how much money you keep. Who cares if your practice brought in $10 million if you can't keep any of it? And so here's a quick example. I'll give some quick numbers, some simple numbers to give you a perspective of what we're talking about. You could have a practice that brings in $1 million a year in revenue. And if it has net profit margins of 50%, after taxes, expenses, and everything, you're going to get a chance to keep $500,000. It literally means every dollar that comes into your practice, you get to keep 50 cents, right? Another example is a practice that does $10 million a year, and its net profit margins are only 5%. That practice also keeps $500,000 a year. But the difference is, for every $20 it makes, it only keeps $1. That's a pretty stressful situation. You basically have a 95% hurdle. 95% of your practice is expenses, and 5% is profit. That's not something that allows you to sleep well at night. We found that as the margins decrease, the stress level increased. If you find yourself in a highly stressful situation in your practice, and that stress is related to finances and it's not a specific employee or something like that, that stress is related to finances, I highly recommend you check your net profit margins. I'm going to give 5 common killers of net profit margins. I know these are 5 common killers of net profit margins because these are the 5 things that we did that killed our net profits. And so I highly recommend you look through this and see, do any of these things describe your practice? And if so, you maybe want to think about figuring out a way to adjust these 5 killers, removing them or reducing their impact in your practice. Number 1, low reimbursing insurances. When we got started, we took every insurance. Doesn't matter how well it paid, how well it didn't pay, we took everything. At the time, because we were operating in a very, very low expense model, we didn't have a physical location, and we had reduced a lot of our expenses by renting space out of hospitals and traveling. It wasn't as impactful. We didn't feel how much these lower paying insurances affected us. But once we did kind of go the traditional route and establish a physical practice and location, we really felt the sting of these lower reimbursing insurances. For example, let's say the baseline insurance reimburses $100 for a normal office visit. We won't get into billing codes or any specific details, but let's say they reimburse $100 for office visits, and you have a whole swath of insurances that are only reimbursing $50 or $55, or and you have to write off the remainder of that amount. That has a powerful impact on your margins long term. So number 2, overstaffing. There's an economic principle called the law of diminishing returns, which basically says that when you do more and more of a certain activity, you get less and less results from that activity. For example, oftentimes as you hire more and more people, they become less and less efficient. You want to make sure that you're staffing right at that level of efficiency, and figure out at what number does efficiency begin to drop off. You want to make sure that your team is challenged every day. I'm not saying overwhelmed, but definitely challenged. And I recommend paying them well for that. They should be paid above market rate if you're going to ask them to do more than the average person in a similar position would do. Number 3, low volume in cash pay services and product sales. We were in a situation at one point in time where we were doing hardly any product sales and very little cash pay services. Why is that important? Because anytime that you're getting money from insurance, you're always going to have to write off some of that amount. Insurance is not going to pay the total amount that you bill. That affects your margins. And then also, too, you have to use a billing company who's going to charge a percentage of the amount that you collect. That's also going to affect your margins. So anytime that you can get paid on something in cash, you forego the need to write off huge amounts, and you don't have to pay that huge percentage, or even if it's a great percentage, it's some percentage. You don't have to pay that percentage to your billing company. Number 4, overspending on equipment. Buying the lathes that everybody said you should have. Buying the this machine and that machine that everybody says you can have. My personal thought process is you want to make sure that there's already a demand for that equipment before you make a big, huge purchase. And you want to figure out if there's a way that you can maybe buy that equipment used, or if there's some kind of deal that you could work out with somebody who has equipment, where maybe you could do some marketing or advertising for this person or this company, and it could get you a discounted rate on the equipment. But overspending on equipment will definitely have a huge impact on your margins, especially if that equipment is not bringing in revenue. If you've made a huge purchase and that purchase is just sitting in a room somewhere, it's impacting your overall margins in a negative way. And last but not least, overspending on your clinic, whether it's the build out, whether it's buying a building, whether it's how you decorate it, whether it's how you, it has to be in a certain area of a certain city, and that's the most expensive block there is, whatever the case may be. I'm not saying not to do these things. I'm not saying you shouldn't do these things, but I'm saying you should understand the impact that it has on your margins. One big mistake that we made is we were making decisions on our space without thinking to ourselves how those decisions what kind of return those decisions would produce. When you're deciding to buy a piece of equipment, when you're designing your clinic, when you're building it out, when you're working with the architects and figuring out what the clinic is going to look like, the question you have to ask yourself is, by spending this dollar, what is going to be the return? Every dollar that leaves your pocket, you have to look at it as an investment that will eventually bring a return back. The overall premise of everything what I'm saying is that margins matter. The kind of margins you have will determine how well you sleep at night. The kind of margins you have will determine how excited you are to get up and go to work every day. We start our practices. You start a medical practice because you want to work for yourself. But when you have super low margins, you end up working for everyone else. If for every dollar that comes into your clinic, you only keep 5 cents, well, you're 95% owned by taxes, insurance, staff, supplies. Everybody's getting paid except you. You want to expand those margins. I feel like it becomes a lot more easier to breathe margin wise when you're at least at 25 to 30% or more when it comes to margins. And so, again, margins matter. So keep an eye on your expenses.
What other specific topics related to the business of private practice management would you like for us to cover? Please share in the comments below or reach out to us on social media or our email address, DermBiz@gmail.com. Our mission is to create a movement of collaboration and support amongst physician-owned private practice owners. If you would like to join that movement, again, don't forget to like, share, comment, and please don't forget to subscribe.